This is the basic professional trade management portion of the core trade management module for Pivot Boss Masters. Let's get started. Professional traders rely on various scaling techniques to manage risk and offer flexibility while managing a trade. This is very, very important. I believe that risk management, along with auction market theory and along with mindset, are the big three that contribute to profitable trading. And those are the big three that professional traders use most often. They know how to tame their mindset and their inner trading demons. They know how to reduce risk throughout the life of a trade, and they know how to identify the best opportunities using auction market theory. So that's what we're focusing on here, is using various scaling techniques to help eliminate risk throughout the life of the trade, so that once you book that initial first target of profit, you are now in either a guaranteed state of profit or you are in a guaranteed break-even trade. And what that does is that helps reduce that mental aspect, that emotion tied to the trade. Because if you've already taken a first scale at your first target, and that means you have a break-even trade behind you, or maybe even guarantees a small profit, then now you have really nothing to lose, and you can let your trade play out to your given targets. So it's a huge deal, and I'm going to show you how easy it is to use 4 different scaling techniques to continue to manage trades like a professional, and also give you some flexibility when you're managing these trades. So these are the 4 scaling techniques that I'm going to show in this basic professional trade management portion. Obviously, in the advanced professional trade management portion of the core trade management module, we're going to look at much more detailed use of these strategies and how to add optional scales and re-adds and pyramiding and all those things. But for right now, if all you know how to use are these 4 scaling techniques, even if you only use one of them predominantly, you're going to get a leg up in your trading immediately, because you're going to eliminate those big losers. You're going to get a lot of break-evens, some small winners, and you're going to hit some home runs. That's the way that these trade management strategies are set up. So the 2-part management strategies, it's almost like football. You know, when the coach is calling for a certain offensive formation, they'll say, the 21 personnel go in. Or when they're calling the defense, the 43 defense or the 34. This is very similar. I call it the 11 scaling technique. That's the first one. The 21 scaling technique is the second 2-part management strategy. And what this does is it helps you remember, and it's easily identifiable, that an 11 scaling technique, you scale 1 on the first half and you scale 1 unit on the second half. And these units can contain as many shares or contracts that you want per unit. So basically what you're doing is you're scaling out of half your trade on the first unit and scaling out of half your trade on the second unit. Now half your trade, or each unit, can be however many contracts or shares you want. So that's what makes this technique so great. That's what makes all these techniques great, because I can use it, you can use it, and some of the biggest fish traders out there can use it as well. The 21 scaling technique is the same thing. You scale 2 units on the first and 1 unit on the back end. And then you have your 3-part management strategies here. The 111 scaling technique and the 211 scaling technique. The 111 is a 3-part scale that basically exits your trade in a third, a third, a third. So you're scaling 1 unit at each target. And you're also doing some stop shuffling along the way to guarantee either a profit or a break-even trade. The 211 is very similar. In this case, you're scaling out of half the trade on the first target and scaling out of quarters of the trade on the final 2 legs. So it's 211, 2 units, 1 unit, 1 unit. So these are the 4 techniques that we're going to learn here. We're going to look at some charts and also give you the rules for them, but they're very simple. But by doing these techniques and by using these trade management strategies when you enter a trade and doing it automatically, you're eliminating the emotion from the trade. You're eliminating any kind of guesswork. You have a set, automatic, mechanical approach. Every time you enter a trade, use one of these techniques, and you're going to see immediate results in your trading because, again, you're going to eliminate those huge losers. You're going to continue to book consistent small profits. You're also going to get some of those home runs as well. So let's take a look at the first two-part management scaling technique, and this is the 11 technique. I also call this one the free trade technique, something I taught for a while. But the 11 scaling technique, just like many of the others, is designed to completely remove the risk upon reaching your first predefined target, T1, thereby allowing you to manage a runner without emotion. So what this trade technique is designed to do is scale out of half your trade as soon as you hit your first predefined target. And once you do that, all you have to do is get that first target. And if you can get that first target, you've got a completely break-even trade on your hands. You will not lose money. You'll only pay commission, which is just the cost of doing business. And at this point, you're giving yourself a shot to reach a bigger payday on the last half of the scale, whether you're using it as a target destination to T2 or if you're using it as a runner. So what this one is designed to do, again, completely remove the risk upon reaching your first trade, is designed to remove the emotion from trading. Because again, as novice traders start this thing, there's a lot of emotion in trading. Or even if you've been at this for many, many years and are still not consistently successful, a lot of times emotion in the trade is what's doing that. By using these scaling techniques, you're removing that emotion because every single trade has a set rhythm of how it's going to be managed. And once you push that trigger button to enter the trade, you should be sitting on your hands at this point. Because now there's nothing left to think about. You just let the trade do its thing. And once you hit that first scale, it's a break-even proposition. So this is a great all-purpose trade management strategy. It's also designed to inspire confidence because, again, you're not going to lose a bunch of money. As soon as you hit your first scale, you're break even. And once you get that first scale, you've also booked a little bit of money. Even if it comes back against you and takes you out on the last leg and gets you break even, at least you get used to consistently booking those gains because booking gains becomes contagious. You got to book those first gains. This approach is also perfect for traders struggling with consistency or even novice traders because what it does, again, is it forces you to have discipline in your trading. It forces you to stick to your fixed loss. It forces you to have some type of risk mitigation tied into your trade management because a lot of traders really don't have this. And that's why I mentioned in the introduction to the trade management module was that if you take on one of these scaling approaches and you use one of these approaches in your trading, with discipline, you're ahead of 90% of the traders out there. And already, that's what you're trying to do, is be in that top 5 or 10% of traders because those are the ones that are making money. The other thing is, if you are trading poorly, maybe you're in a losing streak, you hit 2 or 3 or 4 or 5 losers in a row using other scaling techniques, well, this is always a good one to come back to so that you cut down on size. And then you're also giving yourself a free trade technique whereby if you get that first target, again, you're guaranteed a break-even trade. And at that point, you've stopped the bleeding of losing trades. So this is a great all-purpose trading strategy here, especially for those of you that are still struggling with consistency. So how does the two-part management approach work? Well, first you have to obviously enter a trade with a total number of contracts or shares that is divisible by 2. So you got to be able to split it evenly because you're scaling half and scaling half. So you can't trade 9 lots because you can't split 9 lots. But you can trade 10 lots and split 5 each. Or you can trade 2 lots and split 1 each unit. So you have to at least trade 2 contracts or 2 shares. And you have to trade a total number that is at least divisible by 2. Number 2, the price differential between the stop and the entry should be equal to the distance between the entry and the first target. So your stop away from the entry should be the same distance as your target from the entry. And again, it's this symmetry that allows for you to be able to remove that risk once that T1 target is reached. Now we go to step number 3. If the stop is hit before T1, then you exit the full position with a loss. You're done. But if T1 is hit first, your first target, if it's hit before the stop, then you exit half of the trade at the first target and you leave your stop in place for the last half of the trade. That gives you a break-even trade. Now, if T2 is hit, the second target, before the stop, then you exit the last part of your trade with a profit. But if the stop is hit first, you exit the trade and you lost no money except for commission. So let's take a look at how this looks on the chart. This is a 2500 volume bar chart for the ES. This is my execution time frame. I really like the 2500 volume bar chart. But looking at the two-part scaling technique, the 11 scaling technique, 11, you're scaling 1 unit on the first half and 1 unit on the second half. So that's basically half and half. You enter the trade. Say we get our entry here at 72.25. That's our entry. Right now, we are flat, so there's $0 that we have lost, or ticks in this case. We put our initial stop here, and that is 6 ticks away from our entry. So 6 ticks away from our entry, and that stop is 70.75. Since we have 2 units, 2 times 6 gives you 12. So if we hit our fixed loss stop before we hit our first target, we lose a total of 12 ticks on that 11 scaling technique. Now again, remember, that 1 unit can be 5 contracts per unit. It can be 1 contract per unit. It can be 10 contracts per unit. That's the beauty of it, because you can trade whatever size you're comfortable trading, and you can grow into that size as well, which we'll talk about later. But right now, if you hit that fixed loss, 6 ticks times 2 units is 12 ticks you lose on that trade. But if you hit the first the first target here, which is T1, hit that target, that's a +6. If you hit that target, you immediately remove the risk. Why? Because by triggering this target and getting a +6 on it, allows you to keep your stop right down here at 70.75, which is a -6 ticks, but you just made a 6 ticks. So you just canceled out this loss with this gain. So now your risk is 0, but you have to get that first scale first. Does that make sense? So you're risking 6 ticks, price pushes higher 6 ticks, and you take half of the trade off. So now you're up 6 ticks. You have 1 part of the trade still left. And that part of the trade is sitting right here where you just covered, where you just exited half that trade. So really, right now, you're up 12 ticks. If you add the one that's still in trade. Well, if my stop is still down here on that last half, and I'm up 12 ticks right now, and this is 12 ticks lower, well, then that's a break-even trade. That's why this is so important, because now, if you're long from here, and price pushes up and barely gets your scale right here at a +6, that's all you need. Now, you don't have to worry about the trade because you're not going to lose money. You're not going to lose money. You guaranteed yourself a break-even trade even if your big stop is hit way down here. Now you just sit back and relax. So we'll go to the next slide. So now here is the next one. And basically what this shows here is that on the second half, we're still long and our stop is here. Notice if we hit that stop now, all the risk is gone. There's no red there. We get a break-even trade. It's green, it's green, it's green, it's green. Everything's green now, which is exactly what you want as a trader. So you have an option. 2B is optional. You can move your stop to the entry on the last unit to guarantee a profitable trade. So instead of having a break-even trade by letting it come all the way to here, you can move your stop to the entry right here. And if that happens, you've then booked a +6 on that entire trade. Okay, that's the optional approach. The standard approach, you keep this stop alive. So price has to auction all the way back to here to get you out, which is 3 points, 12 ticks in this example. That's a long way, especially after rejecting a new low and having this pop higher. So now that we're still long, that second half, you allow price to run to your second target, T2. Right here, that's a +3. So here's your entry at 72 quarter. You get a +3 at 75 quarter. +3 along with the +6 that you broke early on, that gives you a +18 total for the trade. +18. See how that happened? So if you go back to the first entry here, we started off and we had 12 ticks of risk. That's why it's red. You'll lose 12 ticks. But as soon as we hit this target, all of a sudden we're break even. This is no longer there, and now we're already sitting with nothing but profit ahead of us, green. So that's good. Now we just let it hit either the second target, or this is a break-even trade now. You're not going to lose any money even if price comes all the way back here. So what you can do is you can either play to a fixed profit like this one here, or you can allow the trade to run risk-free. So you can trail a runner. So as price pushes higher and you get that higher low, you put the stop there. As price pushes higher, you get a higher low, you put the stop there. And so on and so forth. But right now, it's a good high-class problem to have. Should I take my target or should I let it run? Either way, you got yourself into this trade and you eliminated risk immediately and allowed yourself to have a mentally clear picture of how you want to manage the last portion of the trade. Without clutter, without emotion, you just allow it to go. Because you're not going to lose any money now. You're actually going to make money. Because as price gets closer to your T2, you can move your stop from down here to the entry. And then you can leapfrog that thing back higher. So if you come very close to coming to T2 and then all of a sudden turn around, you at least book some profit. So that's the 11 scaling technique, a very, very powerful technique, one that you can use in any time frame with any type of instrument. So you can swing trade with it, position trade with it. As a matter of fact, it's a great investment approach as well. Because if you buy stock, for example, or an ETF or a mutual fund, whatever your fixed loss is, make that your first target above the entry. And when price hits that first target, take half off the table and leave your original fixed loss. And now you are guaranteed to have a break-even trade on that investment. If you do this with everything you do, you're going to do very, very well. All right, let's take a look now at the next scaling technique. And this is a two-part management. This is called the 21 scaling technique. And there's many other hybrids as well. You know, for example, you can do the 12 scaling technique. But this is the 21 scaling technique, and this one guarantees a profit upon reaching the first target because you're scaling out of 2/3 of the position at T1. So when you leave your exit and your stop at the original stop level on the last third and you hit it, you still make a profit because you doubled down on the T1. So in this case, you're guaranteeing yourself a profit, which really helps you manage that last runner without motion. Because now if you've guaranteed yourself a profit, instead of just a break even, now you can just really sit on your hands and let that runner go as far as it can, or just let it comfortably go to your final target without stressing that it has to get there. So again, these bullet points are the same bullet points for the most part, except for this one guarantees a profit. But it's still designed to remove emotion. It's great for higher risk scenarios because if price is, for example, downtrending big time and you're trying to buy a falling knife, well, you can use this technique to get in and scale out hard 2/3 immediately. So even if price comes down, you make a profit really quickly. So this is a great option for high risk opportunities. This is also designed to inspire confidence, great for consistency, and again, another one of those approaches that is really good when you're trading poorly. So anytime we get into a slump, you can pull this approach out, and it's going to help guarantee profit right there once you hit that first T1. So this is a good approach here that, again, is something that you really want to have in your arsenal. So let's take a look at how you actually execute it. The two-part management technique, which is the 21 scaling technique here, you have to have at least 3 contracts to trade this one because you are scaling 2 at first, 2 units, and then 1 unit last. So that's 3 units. You need at least 3 contracts or 3 shares, and each unit can contain however many contracts or shares you want per unit. So again, we'll look at examples of this later, but as long as you have at least 3 contracts, you're good to get in. Now, T1 in the entry must equal the distance between the stop and the entry. So once those are equal, you're good to go. And now, if the stop is hit before T1, you're out with a loss. Again, no questions asked. You're out. But if T1 is hit before the stop, then get out of 2/3 of your position and then leave the stop in place for the last third. And that gives you a guaranteed profit. Now, if T2 is hit before the stop, you exit the position on the last portion of the trade there, and you have a profit. But if the stop is hit before T2, exit the trade, but you also make a profit. It's a great trade management scaling technique. Let's take a look here at what it looks like on a chart. Basic pro trade management, 2-part management, 21 scaling technique. This is a good one. The important thing to keep in mind right here is this right here. The distance between the entry and the stop needs to be equal to the distance from the entry to T1. Those need to be equal, and they are 6 ticks and 6 ticks in this example. If you get stopped out after the entry, since this is a 3-unit trade at 6 ticks here, 3 times 6 is 18 ticks. You're out 18 ticks. That's your loss if you get hit. Okay? Now, if price comes up and hits your first target first at 72.25, you just made 12 ticks because you just got out of 2/3 of your trade. 2 times 6 equals 12. Okay? So you just made 12 ticks if you hit your T1 target. So you exited 2/3 of your trade at that level. You still have 1/3. You still have 1 unit on. And that unit is right here, right where you exited, right? At least initially. And at that point, that 1 unit is still up plus 6 ticks, right? Because here's your entry. It's still up 6 ticks. You already booked 12. Plus 12 and a plus 6 equals 18. That's a plus 18 right there. Okay? How much is the distance between this price here where we scaled and our current exit? Well, add these 2 up and that's 12 ticks. So right now the distance is 12 ticks from our current price and our stop. And we're up 18 ticks, and this is 12 ticks lower. So if our price comes all the way down here and hits our stop, we're still up 6 ticks. Guaranteed a profit. That's why. Just get price to get those 6 ticks. You get 2/3 of your trade off. Your last one is here at your stop, and you're going to be guaranteed, in this scenario, a winning trade. As we move on to the second portion of the trade, now everything is green. If price hits our stop, we're guaranteed a plus 6. If, after you hit T1, you put your stop to the entry, you made a plus 12 right there. Sometimes it's okay to do that. You know, why leave a big three-point stop here if all of a sudden price can't catch a bid and you start dropping? If you feel pretty confident that this is a low that could lead price back to value, especially when you see divergence and other things that make you feel like this thing could push higher, then just leave your stop right here, right? You're still guaranteed a profit. You're giving yourself some space between here and here to allow it to do whatever it needs to do before it does this. So as you leave your stop here, price continues to work its way higher. Again, in keeping in with the theme of the prior example, you can take the second portion of the trade off at T2, which is a +3 in this scenario. And if you take off that final unit, that 1 unit off, the final third off, at T2, you made a +24 on that trade. And after you hit those first 6, you had 0 risk. And in matter of fact, you were going to make +6. So in a mere however long it took you to make 6 ticks, you immediately went from risk of 18 ticks to a +6 profit. And a little while later, you come up here and you make a 24 tick profit. That's fantastic. Or you can keep this as a runner. Because again, not only is it risk-free, but you're guaranteed a profit. So again, another high-class problem. Do you take your target or do you let it run? Every scenario is different. In this case, price rejected big time right here and dropped back. But when we had a modest lower low, price rebounded and came back to that level. So you may want to take your profit here because it was rejected last time. Or you may feel strongly that this rejection of these lows will lead to a push through this high, in which case you could keep a runner. So every scenario will dictate it, and your feel as a trader will continue to get better and better as you use these techniques, and that's where the flexibility of these techniques really come in, because you have so much flexibility to do different things when you're using these scaling techniques. All right, let's look at our first 3-part management scaling technique. This is what I call the 111 scaling technique. It's where you scale a third, a third, a third, or scaling 1 unit, 1 unit, 1 unit. And what this technique allows you to do is remove the risk upon reaching that first target, but it also provides a ton of flexibility when you're using discretion as a trader. So professional traders really, really like this style approach. As a matter of fact, both of the 3-part management strategies that I'm going to show you are choice strategies by professional traders. And in this case, you're scaling 1 unit, 1 unit, 1 unit to allow yourself to remove that risk. And then you still have 2 other legs that you can do different things with, to either remove risk completely, or to confirm a booked profit, or to add back on risk after you've taken a profit on an initial leg. So there's so many different things you can do, and we'll explore all of those in the advanced trade management portion of this course. So let's look at the rules for implementing a 111 scaling technique. First of all, again, it's a 3-part scaling technique, and it's 1 unit, 1 unit, 1 unit. So you need at least 3 contracts to start, or you need a starting position that is divisible by 3. Okay? Next, the differential between the stop and the entry should be equal to the distance between the entry and T1. So the first 3 scaling techniques are all the same with this regard. The stop to the entry should equal the distance from the entry to T1. Okay? Next, if the stop is hit first, you're out of your trade. No questions asked. Like a robot. No emotion. No emotional tie to that trade whatsoever. If T1 is hit before the stop, exit a third of the trade. And then leave the stop in place for a third and move a stop to the entry for a third. This stop configuration guarantees a break-even result, even if all stops are hit from here on out. So again, all you have to do is get that first target. And if you do, you're guaranteed a break-even result, which helps you mentally. It helps clarify. When you can remove that emotion tied to the trade, things open up and you allow the market to work in your favor at that point. If T2 is hit before the stop at the entry, then exit a third of the trade there for an additional profit, and either leave the stop on the last third where it is or bring it to the entry. And lastly, scale that third at T3 or keep it as a runner. So let's take a look again at what this looks like on a chart. All right, here is the three-part management scaling technique for the 111 scaling technique. Basically, this is the third scaling technique. It allows you to stack your stops and play with your orders in a way that allows you to get a break-even result fairly easily. And then it gives you flexibility to add, re-add, scale in and out of trades along the way, and gives you flexibility on how you work those last legs of the trade. Because every trade is different, but you can always have a framework of what you're working from. So in this case, again, you want these 6 ticks to match these 6 ticks. It doesn't always have to be 6 ticks. This is what I'm using in this example. When I trade with the ES, I use a 6 tick stop. That's what I use. So I'm giving you an example with 6 ticks. But this could be 2 points. It could be 3 points. If you're a swing trader, it could be 10 points. I mean, it could be whatever you want, really. I prefer six ticks. But sometimes I'll do 2 points. Because when the market is moving fast and moving heavy, 6 ticks isn't a whole lot. You know, other markets, when the market is more contracted and trading in a balanced range, 6 ticks may come, a lot slower. So I adjust this to the tempo of the market. But typically speaking, I have a 6 tick risk. That's my ES stop. But when the market's hot and heavy, I might have a 6 tick risk. But if price pushes way up very quickly, I might raise T1 and actually grab a couple extra ticks or a couple extra points. So I may get a +3 on the first one, and now I'm really in the money. So it really provides flexibility. And again, we'll talk about that flexibility in the advanced portion of the trade management. First, you don't need any flexibility at all to begin reaping the benefits of these scaling techniques. So again, these two are equal distant right there. And after your entry, if price hits the stop first, again, this is a 3-part scaling technique. So you have 3 units. 3 times that 6 ticks gives you 18. So you have an 18 tick loss on this particular trade if this stop is hit. Now, if price pushes up and hits that T1, then we exit a third, just a single third of that trade. And you can see we get a +6. So you exit a third, 1 unit, right? The next thing you do is keep the stop right here for a third. And then you raise a stop to the entry for a third. That is the configuration for a break-even trade. Okay? Because you just made a +6. You're going to keep the stop on 1 at a -6. Those two wash. And then you're going to move a third to the entry, which is 0 if you get stopped out, which is a wash. So this +6 washes this -6. And then this third washes itself out at the entry. That's a break-even configuration. Does that make sense? I know there's a lot of squiggles there, so I'll do it one more time. You have your entry here, and when you hit that first target here, it's a +6. After you hit the first target here, at T1, you keep the stop on one of your thirds right where it was. That's a -6 on that third. And then you move the stop to the entry on one of those thirds. That's a flat trade. So you just made a +6. You have a 6 tick risk on one contract. Those two wash out. And then you have one at the entry that's flat, and that washes out. That equals a break-even trade, and now you've lost no money. You gave yourself a shot to write a winning trade. Okay? That's if you get this first target and price comes all the way down. You still made a break-even proposition. Taking out this one and taking out that one. Okay? In this particular case, price hits this target and then rotates lower after that target and hits our exit, knocking out one of our thirds, and then we did a +6 on one of our thirds. Okay, so let's look at what that looks like now. Here it is. So after you get your first scale, you can see right here, this goes to 0. No risk. Because what we did was we moved the stop up for one of the contracts, one of the units, and that one went flat. And then we came up here, and remember we made +6 on one of the units, and now we still have one leg on the trade. One leg on the trade. If price comes all the way back here, that one leg is worth 0, and we got a break-even trade. When price is at the entry, we're up 6. When price is at T1, we're up 12. But what we did here was after we scaled here, we put a stop right there on that third. And in this case, it got hit. Sometimes it will, sometimes it won't. But that's a sacrificial lamb right there. If it comes back to the entry, you got to sacrifice it, because what you're doing is you're controlling your risk on the way down. Because if it comes all the way down here and you're still holding on to this one, then you're not a break-even trade anymore. You just let price come back 3 points against you, and then you would be taking a 6-tick loss. Instead, take that scale, move that stop up to here, and if it comes back, mitigate that risk. Take it off. It's okay. And in this case, you've taken some off the table, and then right here, you're good to go. Now it's like, hey, I just took that one off. Now I'm good. Yes, it sucks that I took it off on the low tick, but that's okay, because you're still in a third. You're still in a third. And you could capture all that potentially. So if you got 72s here and now price is trading 79s, your sacrificial lamb there allowed this one to run higher. It's almost like a fullback in football. You got a fullback, a lead blocker, and he's there to knock a middle linebacker out or whomever, to open the door for the running back to get a bigger move. This is the fullback right here, taking one for the team. This is the running back busting out of the backfield to run higher. Sometimes the fullback creates a hole and the fullback is running down the field. So you'd actually scale much higher and you won't get stopped out. Sometimes you won't get stopped out. He's running down the field, and so is this one. And that's when you get the big moves. So if you look at this one, this is part 3 now. So if you come all the way back and take yourself out here, it's a +0. So you're break even. If it comes back to the entry, you're at a +6. You can move your stop up to the entry at this point. If your current last leg is sitting at T1, you're up +12. If you take a profit right here at your predetermined T3, then you make 18. You just made 18 on that trade. Or you can let that risk-free leg continue to run toward a predetermined target that's much higher. For example, maybe the top of value here. Maybe it's value here. Whatever the case may be. But you have allowed yourself to have this ability to hold this thing because you reduced risk along the way during the life of this trade. Let's take a look at the 3-part management approach for the 211 scaling technique. Now, this 211 scaling technique is one of my favorites. It is also a choice strategy by many professional traders. It's one of those strategies that offers a significant amount of flexibility. You can trigger more contracts or size with this approach and still maintain a really good risk profile, and as a matter of fact, get to a profitable outcome very quickly upon reaching T1. So this is a solid all-purpose trade management approach. It's one that you can use in your trading for any type of trade you want. So this is really the all-purpose trade management approach that many professionals use, along with that 111 scaling technique. And these two are just really the cream of the crop at times when it comes to how professionals manage their trades. In this particular approach, you have to have a total number of contracts or shares that is divisible by 4. This says 3, should be 4. And this approach needs to be 4 contracts because, again, you're going half off here, and then right here you're doing a quarter and a quarter on the last. So it needs to be divisible by 4. And the price differential between the entry and T1 is different than the other scaling approaches. It's not equidistant. Instead, the distance between the entry and T1 needs to be half of the distance from the stop to the entry. It needs to be half the distance. So T1 needs to be closer by half than where your stop is. That's something to really, really keep in mind. The other thing is, if the stop is hit before T1, you're out of your position. No questions asked. Again, very mechanical. Move on to the next one. But if T1 is hit first, you exit half of your trade right there, and you leave your stop in place for a quarter of the trade, and then you move your stop to the entry for a quarter of the trade. Again, very similar to that 111 technique. This guarantees a break-even result if all stops are hit. If T2 is hit before the stop at the entry, then exit a quarter of the position and either leave your stop where it is on the last quarter or move it to the entry, and then scale the last quarter at T3 or keep it as a runner. So let's see what this looks like on the chart. So if you take a look at this entry here, we have our same entry, and this time look at the distance here. We have 8 ticks of distance, and then T1 is only 4 ticks of distance above our entry. So this distance right here is times 2 of this distance. Okay? That's important again, because you're scaling out of half your trade at this level. If you reach that T1 target, 2 units by 4 ticks gives you an 8 tick profit. But if you hit that loss, you're going to lose 24 ticks. At the entry, you're flat. And the idea here is get 4 ticks as quick as possible, right? And if you do, scale half that trade, and then what happens is you limit the risk. So you can see right here, leave the original stop here. After you trigger that plus 4 on 2 units gives you plus 8. So now what you've done is you move your stop on one of the legs to the entry, and you keep a stop at the original exit point. So now if price comes back against you, you exit 1 flat, but you still have a plus 8 in your hip pocket for that last leg because you booked it up here. Now, after getting taken out right here at the entry, we still have a quarter of the trade on. And if a quarter of the trade continues higher here and hits our T3, which again is the same level, plus 3, you've now made a plus 20 on the bulk of that trade. You made a plus 12 right here because you had the plus 8 from the first half, and then you had the plus 4 from your last quarter, so those add up to 12. And as price pushes higher into this target, you make another 2 points, and that gives you 20 total. So 8 ticks onto that 12, that's 20 total. Or, again, if you want to leave it as a runner, you have a risk-free opportunity. If price hits your stop from all the way over here and comes all the way down, you don't lose any money. You don't lose any money. That's called a theoretical average. That's what that term is called, a theoretical average, because you entered the trade here. This was your entry. But when you book profits higher and higher, those gains are then used to give you a bigger cushion against your entry. So if you use these 3 points from your entry up and you book gains in that zone, whatever gains you made, you can then subtract it from your entry and you have a theoretical average. So now your theoretical average entry is 70 and a quarter. That's why it's a break-even trade. Because by the way that you exited this trade along the way and booked profits, you have essentially done it in a manner where it looks like you entered the market at 70.25. Did the market get to 70.25? No. So it's almost like you got the best entry on the entire map because price never got there, and yet your theoretical entry is 70.25. That's what scaling does for you. So you could either take this gain here at T3, or you can just let it run higher, because even if it comes all the way back to here, you're still going to just have a break-even result. And this is the difference between how professionals manage trading and how novices manage trading. Because novices don't have an approach like this. They're all over the board. They don't know what to do. But if you just stick with an approach, any one of these four are brilliant. But you'll learn how to mix and match them. You'll learn how to do various things so that you add to your entries. For example, this right here would be very, very annoying if you got long, got your scale up here, and then price came back and nicked you right on the end. So an advanced approach is when price comes up and you take that scale, if it's a +1 unit or a +2 unit, whatever it may be, when price comes back, add it back at the entry. Add it back at the entry. And now you are adding gains to the same move, which would essentially push your theoretical average even lower. That's what I did in crude oil today. And it's a fantastic trading approach when you're able to scale here and then re-add that scale back. And when price comes back to it, you just made double gains on one leg. So there's going to be a lot of things that we're going to talk about in the advanced section. But again, if all you use are these three scaling techniques, the 11, the 20, the 11, the 21, the 111, and the 211, that's all you need. Let me tell you something else. This is exciting because you may be laughing at my +6 or +4 or +8 that I'm showing on the screen. But this is the real truth behind trading. Scaling is scalable. The secret to making more money is increasing your size once you've mastered your preferred trade management scaling technique. Let that sink in. The secret to making more money is increasing your size. Rather than trying to hit home runs every trade to make big money, increase your size once you've mastered picking up smaller winners with your scaling approaches. So for example, if you're consistently making money using the 111 scaling approach, a third, a third, a third, then all you have to do is increase the size of the contracts within each unit to make more money. For example, if we were using a 111 scaling approach and we had T1 at a +1, T2 is +2 points, and T3 is +3 points, okay? If you were only using one contract per each unit, you scale a third, a third, a third, right? T1 at 1 point, at one ES point, one contract would be $50. 2 points per contract, $100. 3 points per contract, $150. So what you've made on these three scales is 50, 100, 150. That gives you $300 you just made on that trade using 3 contracts, 1 contract per scale. Okay? Now, say you have a setup or a tendency or an approach or some trade that you see often and you knock it out of the park. You know that every time you use that, you see that setup and you trade it, say 7 times, 8 times out of 10, you get all 3 of your scales. If you see that, instead of just trading 1 contract, up the size. Next time trade 3 contracts per unit, or 2 contracts per unit, or 5 contracts per unit. That's the goal. If you can consistently make those scales, 1, 2, 3, using 1 contract, all you have to do is increase the size because you are already programmed to make that trade over and over and over again. So if you do 5 contracts per unit, you'd be trading 15 contracts, But now that same trade that you've been knocking out and only making $300 per, now you're making $1,500 per. 5 times the money because you're trading more size. Should the size scare you? Well, margin should scare you, right? But in terms of trading size, if you're using a trade management approach like this, and you know that you can knock these scales out and you do it time and again, then increasing your size, doubling the size from 1 contract to 2 per unit, or tripling it, 3 contracts from 1 per unit. Mentally, it provides a much better transition instead of just saying, hey, I'm going to go from trading 1 contract to trading 10 or 50. All in, all out. That's tough. But when you're scaling in this approach, it relieves that mental anxiety, that emotional attachment to the trade that it has to be a winner because you're long 15 contracts. I'm long 15 contracts and it has to make money. That's the type of mental mindset that can get you into some deep trouble. What these scaling approaches do is it eliminates that emotional anxiety, that mindset that price has to or must do this because you'll lose money otherwise, because you're going to get that first scale. And if you do, and you will, because using the techniques that we're learning in Masters, you're going to get that first scale. You're going to get that first scale easily. And you're going to get the second and third scales easily. So all you have to do is get really good at mastering those scales. What if you were only playing, for example, a +4 on the first scale, and then +6 on the second scale, and then a +8 on the third scale? That's only 2 points. But what if each of these in the ES had 50 contracts? 50 contracts. 50 contracts at 4 ticks, 50 contracts at 6 ticks, 50 contracts at 8 ticks. Now you're slinging 150 contract lots, but you can get this because you've gotten it time and time again with 3 lots. 1, 2, 3. I practiced with 3 lots. 1, 2, 3, and I would get it over and over and over and over again. And then you go to 2 lots, then you go to 3 lots, then you go to 4 lots. Maybe you go up to 10 lots, and who knows? Before long, you're trading 100 lots. The best traders out there, this is what they've done. They just didn't go from trading 1 lots or 2 lots and go straight to 100 lots. It doesn't work that way. But this is the type of professional approach that gets you primed and ready to move your size up. Because instead of looking for a 20-point ES winner, look for a 2-point ES winner and multiply the contracts times 10. Now you have to look for a much quicker move, and you don't have to look for a ginormous 20-point winner. Play what's there and just play your size. So this is what we're going to be working on as we go through the rest of Masters, but this is the mindset that I want you to get primed for, is using these scaling approaches to continue to approach the market from a professional risk management standpoint, because that's all this is. When you place your money on the line and you trigger an entry, it's all about risk at this point. How much risk do you have on? Mitigate that risk, cut that risk in half, get it off the table, get to a profitable solution as fast as possible, and that way you have mental clarity to allow that trade to continue to progress and make more money. That's the goal with this basic trade management approach. It is a solid, phenomenal scaling approach that I put together here. These 4 approaches, if all you use are these 4 approaches and you use it in the basic, most standard approach, you can make money. You will make money. And as soon as we apply some more advanced techniques to help you identify how to defend those trades, how to re-add scaled legs, how to do various things to create iceberg type positions, those ideas are all founded on this foundation right here. So learn these scaling approaches inside and out, practice with them. Even if you're practicing in fake money accounts, it doesn't matter. Just get used to booking that first T1. Get used to moving those stops around so that you can You have a stop configuration that gets you a break-even trade or gets you to a profitable solution quickly. And that concludes the basic professional trade management portion of the core trade management module for Pivot Boss Masters.